A very warm regards from Pristine. The topic we are going to cover today is cash collateralized debt obligations. To begin with, a collateralized debt obligation is a general term used for an asset-backed security that pays principal and interest from a collateral pool of debt instruments. Thus, a CDO is nothing but a security which would pay me interest and principal from an underlying pool consisting of another set of securities. This is the basic CDO structure. Depending upon what the underlying pool consists of, the CDO would be classified as a CLO or a CBO. A CLO is nothing but a collateralized loan obligation in case the underlying pool consists of loans. It would be called a CBO in case the underlying pool consists of a series of bonds. Thus, CDOs can be further classified based on the underlying collateral or on the economic purpose. Thus, a CDO, if it is classified based on the collateral, we saw it can be called a CLO or a CBO. On the other hand, CDOs can also be classified on the basis of economic purpose, where they can be called as a balance sheet CDO or an arbitrage CDO. We would cover up the balance sheet CDO and arbitrage CDO in further detail later. Now, in order to create a CDO, first the issuer has to package a series of debt instrument. Once this package is sold to a trust or a special purpose entity, the special purpose entity or the SPV will issue another class of securities, and these securities would be issued in different tranches. Thus, here we see there is a set of securities and securities. These securities are transferred or sold to a special purpose vehicle in return for cash. Now the cash is going to come finally from the issuer, who will sell the new set of securities or the CDOs to investors. Thus the issuer has managed to transfer the securities on his own balance sheet in return for cash. Thus he has managed to deleverage his balance sheet or create liquidity for him, or try to release some capital, which is a concern in case of banks, since they have to hold a minimum capital for issuing loans. Once the securities are transferred to the special purpose vehicle and a new set of securities are issued, these securities would be issued in different tranches. Each of the tranche would have a different risk characteristics and a specific cash flow structure. Thus we can see in this diagram there are four tranches which have been created. The senior most tranche is one which will have a commitment in terms of interest payment and principal and would be the safest. Such tranches would ideally be rated a AA or a AAA, ideally, by rating agencies. Following a senior tranche, we would have a series of mezzanine tranches, and then at the last we would have the most riskiest or a junior or an equity tranche. The senior tranche is generally the largest part of a CDO and consists of almost 75 to 80% of the securities, which are generally followed by the mezzanine tranches, and at the last we have got the equity tranches. The equity tranche is normally called the first loss tranche because it will absorb any losses from the debt securities, making them the most riskiest. Once the equity tranche is exhausted, then the losses will be moved on to the mezzanine tranche, and then at the last to the senior most tranche. Now let us try to further understand the need for creating such tranches. It could be possible that some investors might be looking at a very safe investment, whereas some others might be looking at a riskier investment depending on the risk appetite. Thus, different tranches have got a different risk profile and a cash flow structure.